Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Dr. Joel Shulman, founder, CEO, and CIO at ERShares. You're talking about investing in entrepreneurial companies, both public as well as private, and the XOVER ETF, which is the first crossover ETF that will enable investors to invest directly and indirectly in both public and private equity securities. Dr. Shulman, welcome. Great to have you with us today.
Thank you so much. It's a pleasure to be with you.
So before we talk about private companies, I wanted to start off with Nvidia because I noticed that Nvidia is one of the top holdings in your XOVER ETF, and Nvidia's earnings, that was the most anticipated report of this earnings season. Nvidia, as usual, delivered another very impressive beat and raise quarter. Shares were fluctuating between gains and losses yesterday, and today the stock is down. For reference, we are recording on Friday, November 22nd, and it seems some investors are just concerned that the company slightly missed the whisper number. But we should remember that stock is up almost 200% year to date. So I was interested in your thoughts on Nvidia's earnings and why the stock is down.
Well, we've actually been in Nvidia since 2005. When we started our ER30, Entrepreneur 30 Total Return Index in 2005, we started with Nvidia, Amazon, Apple, and some other well-known stocks. And so we got in it, before almost anyone, when it was a $5 stock. And since that time, it's gone up 67,000% and had to rebalance many, many times. Within the Mag 7, this is by far the leading company. But we've got to remember that at some point valuations, start to kick in. And this is a company, not everyone knows this, but this is a company that in the last 12 months or the last 12-month trailing earnings, they've made more money than the prior 30 years combined, right? So this is a company that's just had explosive growth. And when you look at how much they've grown in terms of revenues and profits, and then you look at their competitors, we actually have the opposite. They're losing growth. So Nvidia is sucking all the growth out in their respective sector to the detriment of their peers. And so AI is real. Nvidia is clearly leading in the AI revolution. And at some point, though, valuation metrics have to kick in. So it's not all passive money. The active money, has decided they're going to find something better. We actually have it in our fund. It's we've had it as an overweight most of our last 20 years, but it's currently in our fund. But it's an underweight. So we actually in the Mag 7s, we're in the last 2 years, we've been underweight the Mag 7 because we just think that they've, the best opportunities are at the level just below them. We think it's large caps still, but drifting down, towards the mid caps for best performance.
So now let's talk about private assets, and we have seen a surge in interest in private assets. So private assets are both debt and equity investments in privately owned companies. And these markets are projected to reach more than $15 trillion by 2025 and more than $18 trillion by 2027. And that is according to S&P Global estimates. And now the biggest asset managers, including BlackRock and State Street, they are trying to bring these private assets to retail investors. So before we talk about how they can be brought to the ETF wrappers and the challenges, I wanted to, talk a little bit about interest in these private assets. What do you think is driving interest in these assets?
you've got a number of high profile securities, SpaceX, basically anything Elon Musk touches, you've got a lot of interest. And so SpaceX is one, XAI, OpenAI, that's not a Musk, but you've got a lot of interest in this thing, this area, Anthropic, and the list goes on and on and on. And many of these companies are choosing to delay their public offerings, and some may not ever go public. Many of the companies want to have the control of their privately held company. The valuations for the best companies are certainly not being punished. They're able to get capture the same sort of valuation they might in the public markets. There's enough money with institutional investors who want to come in and are continuing to push the price up that there's no real incentive to go through the filings and the disclosures and the volatility related to the public companies. And so we've seen, for example, the first quarter in 2024, there was more money raised in private equity than anything we will see this year in public equity. So IPOs are being delayed, and it's a trend we're seeing. And unfortunately, by the time many retail investors have a chance to participate, you may see valuations that are somewhat inflated. You may see that they've lost out on 80% of the appreciation, which is a real shame.
Since you mentioned three of the hottest private companies, OpenAI, SpaceX, and XAI, let's talk a little bit about them. So OpenAI, which is the creator of ChatGPT, the latest funding round for the AI startup was oversubscribed, and this included participation from likes of Microsoft, Nvidia, SoftBank, and many other high-profile investors. And after that round, OpenAI's valuation went up to $157 billion. That's up from $29 billion in 2023 and $80 billion earlier this year. So that's some real exponential growth and valuation. But the company is losing billions of dollars. It has many competitors now, and several high-profile employees have left recently.
Yes.
It is also trying to restructure itself as a for-profit company. So what are your thoughts on OpenAI? Do you think OpenAI is a bit overhyped?
Well, certainly you have these high-profile investors who have been part of it. But to your point, you have XAI and, you have, again, the Musk trade, and this guy can do no wrong in investors' eyes. And so it's going to be a zero-sum game. You're going to have a handful of winners and then a lot of losers. And we've seen that, through time. We saw it. We saw it with automobile manufacturing. People forget that 150 years ago, when automobiles were starting to come to the market, there were dozens and dozens of competitors, and then they kind of got weeded out. And the same thing happened in mainframes and in software, even spreadsheet applications. And so right now, you've got a handful of major firms that are competing, but it's a zero-sum game. And so to your point, OpenAI, which has gone up from 25 billion to 157 in about a year and a half. That's an extraordinary appreciation. But so if you look at that, that's a 6x return. You compare it to an AppLovin, which is going up 3,000%. Now this is not writing the code for AI; they're utilizing AI. They've gone up 3,000%. It's the top performing stock on the S&P, the Russell 1000 growth year to date, and they're up over 700%. And as I say, if you go to January 1st, 2023, it's up over 3,000%. We've had we got in early last year. We're up 15, 16x since we got in. It's one of our largest positions now. We've actually I think we have probably more AppLovin than we do Nvidia. And so I think and there are other companies like that they're applying AI, and they're appreciating even more than Nvidia. So I think, or an OpenAI. So there's a lot of growth here. And if you know how to utilize it efficiently and effectively, you're going to dominate your market and you're going to grow. You're going to grow your general gross margins. You're going to cut your SG&A. You're going to widen your EBITDA. This is what AppLovin's done and NVIDIA's done. And you're going to grow revenues at the expense of your competitors. And so that's, I think, another area to look at, especially since most investors are shut out of OpenAI and even XAI. They're not going to be able to participate. So it's a theoretical question. Too much tide, probably. But for those investors who are shut out, which is most of us, there are other opportunities you can get into, and then pretty soon we're going to be delivering through our XOVR the opportunity to get in a small piece, a taste of some of these high-profile companies through our daily ETF.
Right. And you talked a little bit about why so many private companies are choosing to stay private for a long time, mainly because institutional investors continue to pour money into these markets. And then some of these companies, they prefer to stay private because they don't like too much public scrutiny. That may be one of the reasons for SpaceX staying private. And in fact, Musk had founded SpaceX in May of 2002. And that was even before he got involved with Tesla as a co-founder. And SpaceX valuation has risen to $180 billion now. And unlike OpenAI, SpaceX is a profitable company and probably highly profitable. And his XAI startup is now valued at $50 billion. So do you think these Musk, SpaceX, and XAI, they will just stay private forever? Will they ever do an IPO?
Well, they're going to stay private for a while. And I mentioned before this broadcast, I was set to buy both SpaceX and XAI as our first positions last week. And before we were able to sign the papers, it was under review. The tender offer came out and jacked up the price. One of the advantages of having a private company like SpaceX and XAI, they and by the way, the new tender offer has already been oversubscribed 2 to 3 times at least. And so there's just such massive demand for these types of stocks. They can't fill it. They could have raised quite a bit, 2 to 3 times more than they're raising. And so that more or less assures kind of a steady increase in appreciation. And because the ownership table is being controlled, it reduces litigation. And you may recall that earlier this year, Musk was involved with a personal lawsuit where a shareholder who had a tiny piece of the company was trying to turn over, got a class action lawsuit to turn over his $52 billion in compensation, right?
Right.
There are a lot of executives who say, I just don't need this aggravation. Why should I do it? Why should I go public just to let a nuisance lawsuit, try to embarrass me and distract me and my team? So it's these nuisance lawsuits that are really wreaking havoc. And I've been on the front lines for these things where I've seen, lawyers lining up, and some of this is, of course, legitimate. Fraud should be watched and punished, right? But there are a lot of nuisance lawsuits that really make it unattractive for companies to go public now. It's just too easy to bring a lawsuit, and many of them are doing it, just to extract some quick settlement without ever having the intention of taking it to court. So these nuisance lawsuits are really problematic for public companies.
Okay, now let's talk about your XOVER ETF. And this was an actively managed US large cap ETF earlier. The ticker symbol was ENTR. And then in August this year, the fund's ticker and strategy changed, and it is now XOVER ETF, and it will invest up to 15% in private companies, and that 15% limit is placed by the SEC. The SEC requires that open-ended funds, including mutual funds and ETFs, they limit their investments in illiquid investments to 15%. And in fact, many mutual funds, including Fidelity's Contra Fund, T. Rowe Price, Barron focus funds, they have investments in these high-profile private companies. But bringing these private companies to ETFs is a little bit more challenging because the ETF wrapper offers intraday liquidity and pricing. So we'll talk about that 15% part later, but let's talk about the 85% part, which will focus on entrepreneurial companies. So tell us about why focus on those companies.
So we have all these entrepreneurs that, in fact, even through the 60s, 70s, again, we had, the different investors who came, the different entrepreneurs in technology, and in the case of Walton with retail. But, it's through today. I mean, we're seeing Jeff Bezos, and we're seeing Zuckerberg, and we're seeing Jensen Huang from Nvidia, and just an extraordinary number of entrepreneurs who are creating wealth. They're not only creating wealth for themselves, but for their older stakeholders in societies, and the communities benefit with the schools can benefit, the nonprofits benefit. There's job growth. So in any given year, you'll see more jobs coming from 20 or 30 entrepreneurial companies than you will for the other, let's say in the S&P 500, than the other 470 non-entrepreneurial companies. So 30 companies can create more jobs than 470. We've seen that for many, many years. Now, when we invest in these companies, again, I mentioned, we have this Entrepreneur 30 TR, Total Return Index. It's not a back-tested, file. It's an actual index that we started in 2005. Again, we started with Nvidia and Apple and Amazon and others, and it's gone up over 2,000% in that period of time. Now, to put it in comparison, the S&P 500 and the Dow Jones Industrial Averages were somewhere around 600%, 500-600%. So this index is up 3x, 4x the S&P 500, and doubled the Russell 1000 growth, which is very hard for many managers to beat. And it's even 500% above the Qs, the QQQ, which very, very few people beat. And in fact, it's doubled in 2024. This index is up over 55%. It's doubled the QQQ year to date. And last year and this year, it beat it quite a bit. So this index continues to demonstrate how entrepreneurial companies are performing well in this country. And then we have a global fund called ENTIX. ENTIX is the second best fund in the last 1 year out of benchmark of 340 funds. It's up over 50%. And year to date, it's almost doubled, the peers. So it's top, 3 fund year to date out of, again, 300 plus funds. So our model on entrepreneurs shows that when it works very well. It doesn't always work. When interest rates rise, we perform poorly. When interest rates are falling, we perform very well. There's probably nothing better than what we have.
Very impressive. Now, so that's the 85% part, which will be invested in public companies. And let's talk about the 15% part, which will be invested, up to 15% will be invested in private companies. So I see two challenges there. First, accessing these assets is difficult. They often have high minimum investment requirements and long lockup periods. And whether you will invest directly in these assets or through secondary markets. And then second part of the question, how will the ETF mark these assets to market? Because these are illiquid and hard to value assets.
So good question. The access is really, through a variety of means. There's some of these stocks, when they get north of 100 billion, there's an active secondary market. And we can, if we choose to price it regularly, there could be a cluster of pricing around certain trades. The easiest thing to do, of course, like a SpaceX or an XAI, when there's a tender offer, which happens every quarter or 6 months, there will be a bump in the price based on that new repricing. So that's the simplest thing to do there. In addition to secondary markets, we're getting access. We've been working very hard the last couple of months to have access to direct placements. And so, for example, Klarna is a name that is preparing to go public, and we have access to that. We could go right to the cap table on a number of these companies. So, we're very sensitive. We've got various partners in place that are sensitive to the demand for different investment ideas, and we're working in many cases with direct access. So we're starting to build. We have an extensive network, but our network is now going to probably 3 levels higher, where we're dealing with major institutions around the world that are kind of looking over us like big brothers. So we're starting to partner with major organizations to kind of take this story to the next level.
So currently, I noticed that there are no private companies in the ETF. Are there any high-profile private companies that investors could expect to see in this ETF anytime soon?
Well, I mentioned, and it's probably a good thing I didn't tell you last week, because if I had mentioned it and then people bought, and then a day later, the tender offer came out, that would have, potentially been a violation. So we came very close to buying, 2 very high-profile securities last week, and then tender offers came out. People probably can figure out who they are. Tender offers came out and disrupted it. But these are names that we've been pursuing for a while. And again, I want to be very careful, as you know, with SEC inside information. I just don't want to disclose what we're doing, out of fear. Not that we would be disclosing we're buying something at NAV, but rather if we disclose something in the NAV, if the tender offer price changes, that could be problematic. So we're pursuing. There are a number of high-profile securities right now that we're aggressively pursuing. We're very close to making announcements, and I just want to be careful not to make a public announcement before it's in the books.
Fair enough. So let's talk about your XOVER ETF and some of the top holdings. So I'm looking at the top holdings, and you talked a little bit about AppLovin. That is currently the top holding with about 6.3% weight. Nvidia is the second, and then you have Alphabet, Meta, Oracle, Salesforce, CrowdStrike, Arista Networks, etc. Can you talk about some of the top holdings that you like a lot and you see a lot of potential?
So these top holdings, the way we compiled our Entrepreneur 30 Total Return Index, it's not market cap weighted, but it's a log 1, which means if you put in an Oracle, by definition, or a Meta or Google, by definition, it's going to have a higher weight, because even though it's log 1, which a log 1 for the listeners who may not understand, it means it's trying to get parity with them. It's not quite equal weighted, but it moves in that direction when you do log 1, log 2, and so forth. And so by having a log 1, we have some of we have 2 or 3 of the mega caps, but they're only Meta was an overweight. The others were an underweight. And we did that primarily because we want to make sure that we're correlated to our benchmark. And we tend to move with the large cap growth, indices, right? We're perceived as large cap growth. But, much of the alpha has been generated this year, last year, from AppLovin. In some of these securities where the active share, if your listeners are familiar with active share, it means you look at your benchmarks, and if they have let's say a 1% weight, but you have a 6% weight, you have a lot of active share that you have more weight to your benchmark in those stocks. And so since we have 30 stocks, we tend to have, 3% or so, 2.5%, 3% in each of our holdings. And some of those holdings, like an App11, like a DraftKings, like a Toast, like a Robinhood, those will have higher active share than our benchmark, and that's where we get the additional performance. So if you compare us to other large cap growth funds the last 2-3 months, we're up since we re-engineered on August 29th. We're up almost 20%, and it's triple the S&P 500, which is up around 6-something%, and more than double the Q. So since we relaunched, we're again getting exceptional performance from our 30 stocks.
Excellent stuff. We'll have to leave it there, but thank you so much for joining us today and for sharing your insights, and good luck with investing in those private companies. We'll hope to see some high profile, some very interesting private companies in the ETF very soon.
Thank you so much for your time. Always a pleasure to be part of your show.
That was Dr. Joel Shulman of ERShares. Let's quickly recap the tickers that we talked about. The ETF is Private Public Crossover ETF, ticker symbol XOVR. The top holding in this fund is App11, and the ticker symbol there is APP. We also talked about Nvidia, and everyone knows the ticker symbol NVDA. And the other top holdings are Alphabet and Meta, and those tickers also everyone is familiar with, GOOGL and MEDA. Thanks for listening. If you liked our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.